Hey everyone, welcome to my YouTube channel, Decaf Finance. Just like Decaf Coffee offers you a smoother, more balanced experience, this channel aims to provide you with clear, digestible insights into the world of finance without the unnecessary caffeine-induced stress. Our topic for today is high dividend yield stocks. Now, for those of you who do not know, these are the golden years of companies that distribute a hefty chunk of their earnings to shareholders as dividends, or in other words, companies with high dividend payout ratio. Today, we try our best to cut through the noise of YouTube hype and dive into this topic. And I know we've all seen those videos raving about high dividend yields, promising a ticket to the good life, and bragging about those unbeatable passive income strategies. But here's the deal. We are here to bring you a more down-to-earth perspective. And we get it. This might not go well with everyone, especially the die-hard high-yield dividend fans. But if you're keen on digging deeper, seeking real insights into the strategic side of dividend investing, stick around. I'll try my best to dish out some detailed explanations, shedding light on why successful dividend investing is not as simple as some YouTube videos make it out to be. So without any further ado, let's move right to our first point, the limited growth potential of high dividend yield stocks. As mentioned earlier, high dividend yield stocks can be characterized by their high dividend payout ratio. But here's the kicker. A sky-high payout ratio might sound good for your own pocket, but it could certainly handcuff a company's ability to invest in its own growth. And if earnings are unstable, sustaining these high dividend payouts can be a real struggle. Let's try and compare a company with a high dividend payout ratio with a company that reinvests its earnings in itself. Imagine this, companies going all in on high dividend payouts may actually have little to no cash left for reinvestment. Unlike their growth counterparts, they could miss out on R&D, innovation, or even expanding their operations in the long term. And just to reiterate, limited reinvestment means limited growth. It's like financial gardening with one hand tied behind your back. Another point to notice is that some of these high dividend yield stocks chill in mature, stable industries. Stability is cool, but it also means their growth potential is comparatively lower when compared to their growth counterparts. On top of that, economic downturn can hit them right where it hurts, in the stock price. Due to the stable nature of industries these stocks exist in, investors might view them as grandparents of the market, doling out cookies rather than hitting the gym. And this perception can mess with the stock's value. To wrap it all up, high dividend yield stocks are like that reliable friend who always pays back borrowed money but never quite hits the jackpot. Understanding these dynamics is your ticket to informed investing. Now, we'll shift our gears to explore another important point to consider: interest rate sensitivity. Think of interest rate sensitivity as the weather for our money world. It's the weatherman telling our favorite stocks whether it's sunny or stormy outside. And high dividend yield stocks, well, they are like the cool kids who always want to play in the park. Whenever interest rates rise, it's like the market is crowded with other performers, especially bonds offering higher yields. Investors on the lookout for a better melody might find these high-yield bonds more appealing than high-yield dividend stocks. And it won't be wrong to say that during this time, the charm of high dividend yield stocks might take a hit. For example, imagine holding a high dividend yield stock offering a 4% yield. And with rise in interest rates, there's a new bond entering into the limelight, offering a sweet 5% yield. Many avid investors might shift their focus from high dividend yield stocks to bond offering better yields. And this in turn will affect the demand for dividend stocks, ultimately affecting their value. Another important point to consider: as interest rates rise, the present value of cash flows from dividend stocks take a hit. The result, a potential drop in the stock prices of our favorite dividend players. To sum it up, investors need to be careful about interest rates. There exists an inverse relationship between interest rates and the value of high-yield dividend stocks. If interest rates goes up, their value comes down. In a similar manner, if interest rates go down, it might lead to a potential increase in their value as well. Transitioning from the intricacies of interest rate sensitivity, let's delve into another crucial aspect of the dividend landscape: dividend discretion. As mentioned earlier, you'll see videos on YouTube asking you to put your money in dividend stocks for passive income. However, what they fail to tell you is that dividends are discretionary. They are not guaranteed at all. Even companies with history of consistent dividend payments can choose to stop or reduce dividends based on various factors. Companies weigh their financial health and business conditions when deciding on dividends. Economic challenges, industry downturns, or the need for funds in a crucial project may lead to a decision to conserve cash by reducing or eliminating dividends. One of the best examples that comes to my mind is General Electric or GE. GE was a champion for dividend investors. However, during the 2009 financial crisis, GE shocked all its investors by slashing its dividends by a whopping 68%. This move shocked those who relied on GE's consistent dividend payments. It's important to understand when a company trims or reduces its dividend, it profoundly affects its shareholders. Share prices may react negatively as income-focused investors exit their position. It's a stark reminder that even established companies are not immune to economic uncertainties or strategic shifts that result in prompting dividend adjustments. In conclusion, while dividends do offer a reliable income, it's crucial that we also recognize their discretionary nature. Companies can alter dividends or stop dividends, and past performance doesn't guarantee future payouts. Remember, diversification and thorough research are key to a successful investment strategy. Now that we know that companies have the power to adjust dividends, let's move on to another important point: taxes and dividend reinvestment. One of the key features of dividend investing is to reinvest the dividend earned in order to buy more shares of the same stock. But there's an issue here. You cannot reinvest the entire amount of dividend received from your share. And that's not because you're going to spend it all on yourself. It's because the taxman wants its share as well. And in order to understand this, we need to know how dividends get taxed. Different jurisdictions tax dividend differently, but most of them do it in the year when they're received, even if you plan to reinvest them. This immediate taxation can lead to what we call tax brag on the overall return of your investment. And in addition to the taxes that you pay on dividend, you'll also have to pay taxes on the shares that you acquire through dividend reinvestment when you sell them. To sidestep these tax quirks, let's talk about tax efficiency. Depending on where you live, you can park your investments in tax havens like IRAs or 401ks, which will help your investments grow tax efficiently. To sum it up, while dividend reinvestment strategy has its own charm, you do need to pay a little bit of attention to tax planning as well. As we complete our deep dive into the world of dividend investing, here's the takeaway for savvy investor. Balancing your portfolio is the key. Acknowledge the limited growth potential of high dividend yield stocks and diversify your portfolio by investing more in growth stocks and other kind of assets as well. Stay well informed about interest rate trends, as these can massively impact the performance of dividend stocks. Recognize the discretionary nature of dividends, conduct thorough research into a company's financial health and its strategic decisions. Be mindful of tax implications of dividend reinvestment and consider more tax-efficient investment strategies. Armed with these insights, you're better equipped to make informed decisions for a more secure financial future. Thanks for joining and happy investing.